Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Well, as I mentioned, we really want to spend the next few minutes going all in on China and everything that's happening when it comes to U.S.-China relations. On that, China wants to see a number of steps from President Trump's administration before it will agree to trade talks, including showing more respect by reining in disparaging remarks by members of his cabinet. That's, Carol, according to a person familiar with the Chinese government's thinking.
That's right. And other conditions include a more consistent U.S. position and a willingness to address China's concerns around American sanctions in Taiwan, according to the person who asked not to be identified to discuss internal thinking. We are all trying to gauge what is the conversation, if there is one, going back and forth, and whether or not there can be some kind of resolution that doesn't impair both of these economies, so important really to global growth.
Well, that's why we wanted to speak with Caroline Freund. She's Dean of the UC San Diego School of Global Policy and Strategy. She was also Senior Fellow at the Peterson Institute for International Economics, a Global Director of Trade, Investment, and Competitiveness at the World Bank, and earlier did time at the Fed and the IMF. She's also the author of the book, Rich People, Poor Countries, The Rise of Emerging Market Tycoons and Their Mega Firms. She joins us from La Jolla, California. Caroline, it's good to have you on the program. I want to start with this idea of respect and really what it means in the way that China is using it, in your view, in regards to tariffs and the tit for tat when it comes to this trade war.
Yeah, I think you have to take into account that China is a country that prides itself on having 5,000 years of civilization. So a 5,000-year history. And they do things gradually. They've had the time to learn to do things gradually. And Trump is doing things very chaotically. And that's not something they're used to dealing with. There have been comments by J.D. Vance and others talking about peasants lending money to buy things made by peasants, lending money to the U.S. So this isn't the way to work with China. They expect to have a deal worked out by the technical folks, and then the leaders to only meet once that deal is worked out. So bottom up and gradual, not the top down and chaotic that Trump is initiating. So
is this just jockeying? I keep wondering, these two economies still kind of need each other, or do they not? Like, is there something we're missing in terms of what's going in internally in China? And Tim and I have talked, we've listened to some podcasts who said, you know, COVID changed a lot of things, and a lot of American businesses pulled back, or executives and eyes on the ground, maybe not so much in China. And there's a lot more sophistication in terms of what they are producing and how they are doing it that maybe is going unawares by the world at large. But help us understand, what is China today? It's not just a manufacturer of sneakers and T-shirts.
No, China is a very advanced country with some of the frontier technologies on things like electric vehicles, autonomous driving, and even in AI, they've made substantial progress, though they're still behind the U.S. But there is a symbiotic relationship. So China is worried about deflation. We're worried about inflation. And these are exactly two sides of the same coin. They have overcapacity. We don't really have the capacity or know how to do manufacturing anymore. And while there have been problems with the relationship, we do need each other. And
why do we still need each other? Why do we still need each other? Because I think there are some who would say, China maybe doesn't. I don't know. Or maybe the U.S. doesn't.
Well, there are a lot of things we get from China that we need to keep our economy going. So we live in a world of global supply chains where parts and components are coming from China as well as other countries. So trying to manufacture in isolation is just frankly a non-starter, won't be competitive in a global market. China's also sitting on 700 billion in US dollar assets. So that's another area where China has a pretty big trump card to play. I don't think they will. It's a country that wants stability. It's a careful in any policy move it takes. But we very much need each other. We need the goods each other produces, and we need to work together and work through this. It's not perfect. Some decoupling is probably good, but sudden and sharp is going to be painful. And that's why we see it with what's been happening with the stock market now. I think we're not only having an own goal, we're on our way to an own hat trick.
The White House press secretary, Caroline Leavitt, said this week that China needs what the U.S. has, which is consumers who spend money. Is that accurate in your view?
Yeah, it is. That's why they're suffering deflation. That's why they have excess capacity. They need what we have, but we need what they have too. We have a population that's used to buying things and buying things cheaply. The growth of the Chinese economy has been part of what kept inflation so low for so long and supported global growth. So yes, they need us, but I wouldn't say that doesn't mean we don't need them. This is going to hurt us both. It may be a question of who it hurts more, but there could be a way to make it a little softer for both of us.
You know, one question that I keep asking anyone who will speak to me about this is, who has the leverage in this negotiation between the U.S. and China? You said the relationship is symbiotic. These two countries need each other. But is there one trading partner that is more powerful than the other, and why?
Well, I think initially it looked like the U.S. because China's economy is already in a slowdown because of demographics, because of their own property issues, property crisis there. So it looked like we had more power. They really, really need our consumer. But there's one thing they have that we don't have, which is a population that they can control and that is more willing to tolerate pain than the U.S. consumer. So at this point, I think it's kind of a toss-up.
So does that just mean President Xi is willing to inflict a little bit more pain maybe on his people, and means he can kind of fight this fight a little bit longer than maybe the U.S. can?
Yeah, and he has more authority. So he has complete control of the media. So my understanding from Chinese colleagues is that in the Chinese press, now a lot of people have access to VPNs, but in the Chinese press, the average person doesn't know that tariffs are over 100% now. So the numbers aren't out there. The information isn't out there. There's a calm there. And there's an ability to control the economy, stimulate the economy, support people that we just frankly don't have, as well as the consumer here who's going to be upset. You saw what happened over price of eggs. Imagine when that's everything you go to the store for. That's
a really good point. That is a very good point. Hey, one of the reasons we wanted to speak to you is you have done so much when it comes to trade. A reminder, you were a senior fellow at the Peterson Institute for International Economics, global director of trade, investment, and competitiveness at the World Bank. How does this trade war end?
That is the million-dollar question. Hopefully it ends with negotiation. So there does seem now to be negotiation with other countries. Trump has made it clear that if Xi rings him up, he'll take the call. So I think we can get there. But right now we have two big trucks driving at each other, and it looks more like a game of chicken. So time will tell, I guess.
Yeah, someone likened it to, what's that crazy wrestling stuff that goes on?
I have no idea what you're talking about.
Sorry. Somebody did on surveillance this morning. I was looking for my tweet, but it was basically that's what it looks like. I don't know. I don't watch these wrestling things. Oh, UFC battle between China and the United States. That's what it feels like. That was on surveillance. Overhead on surveillance. Overheard. That's our morning show. Hey,
you're going to get a lot of pushback for calling UFC wrestling. I'm just going to throw that out there.
I'm so sorry. If the United States aim, Caroline, is to contain the rise of China, if that is the ultimate goal, then what?
Mm-hmm. I think that's a really hard thing to do. China is a big country, so I think it can slow it. I think probably it already has with some of the restrictions on technology. That the other side of that is it's encouraging innovation in and of itself. So the fact that we held back on AI chips probably made something like DeepSeek more likely. So I don't think there's a holding back of a country the size of China. So what we need to work towards is managing in a world with China and working more closely with our allies. So this could have been handled, in my view, much better by working with countries in Europe, countries like Japan and Australia, and sort of isolating China that way, encouraging China to play by the rules that we want to set as a globe. The US is less than 15% of global trade right now. So there's 85% of economic might out there without us. We really can't engage in this fight alone.
Do our allies, and I use that term loosely right now because I think a lot of folks would say we're fighting with allies right now, at least when it comes to trade. Do they feel the same way about China, just in the last 45 seconds we had with you?
I think they're beginning to, and I think one thing this will do is China now needs to sell all the goods it's not selling to us somewhere else, and other countries are very, very worried about that. So in that sense, we may pull them along with us, but Trump's vitriol has certainly pushed them away. So I think we're going to have to see, but I do think there's room for that if we behave a little more nicely.
See, the world would be better if we all just were a little bit nicer. It's really kind of sometimes
looking at me?
that. No, right?
Carol's looking at me when she's saying that.
No, you're super nice. No, I'm not looking at you, but I just, whoa. Caroline, thank you so much. We were really looking to do kind of this deep dive because we feel like it certainly is that relationship between the U.S. and China so important to kind of what happens next globally. She's Dean at the UC San Diego School of Global Policy and Strategy, joining us from La Jolla, California.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, folks, one of our big business and market stories today hit pretty early. Semiconductor shares are selling off. I'm looking at the stocks down about 6% as we speak, and I'm looking at all 30 names in the Philadelphia Semiconductor Index lower in today's session. NVIDIA, the biggest, almost down about 10%. AMD down about 9%. This is new U.S. government restrictions on the export of NVIDIA chips to China and a disappointing report from ASML Holding, really dimming the outlook for the semiconductor sector, wiping out a lot of money, billions and billions of dollars. AMD also saying that it expects to take a charge of as much as $800 million on the Trump administration's new restrictions. So let's get into it. We've got a great roundtable. Bloomberg Intelligence senior semiconductor analyst Kunjan Sabani is with us out there on the West Coast in San Francisco. Also in our San Francisco bureau, Bloomberg Technology co-host Ed Ludlow. Where to begin? Kunjan, let me just start with you because we have seen bans on the semi sector over the last few years. What's the new news and the impact of such?
You know, first of all, there's not a ban, it's a license requirement, which in theory you could get approved. But this was, the event that this happened was not surprising. Maybe the timing was, and the magnitude this time around was much larger. NVIDIA has gone through multiple of such sanctions to China. And every time, you know, they have to take some revenue hit because they could not ship some products. This time around, over the last few quarters, China has been creeping up as a percentage of data center, getting close to sort of 10% in our estimate of as of last quarter. So the magnitude now continues to increase. And I think the charge, the $5.5 billion charge, which we think implies to about $14 to $18 billion of revenue that they could have shipped, implies there was some definite demand pull-in in anticipation of such restrictions.
So wait, let me just fine tune. So not a ban, forgive me. So licensing. So what does that just mean? Another document or something? Like what's the distinction? Because you obviously made it because it's an important one. What is that distinction?
Yeah, the prior restrictions on the Hopper family have come as sanctions where the US government comes and just says you cannot ship this product to China, period. And you have to develop a new product that satisfies those conditions. This time around, it's licensing where they can still ship H20 in theory if they get a license for each respective customer to ship to China.
Okay, important distinction. Thanks for explaining that. I want to bring in Ed Ludlow, who follows, of course, the space closely and specifically asked about this H20 technology, sure. Ed. What is the technology that is being restricted at this point, and where could Chinese companies and where do Chinese companies want to use this tech?
Yeah, it's a so-called AI accelerator or high-performance GPU and other components that go into a system that largely are involved in the process of either training a large language model or, more relevant to H20 and the anxiety of this US administration, inference. The H20 is a lower performance chip relative to like the cutting edge of what NVIDIA does.
So it's the Hopper and not the Blackwell, right?
It's just a variant, right?
Okay.
It's a prior generation to Blackwell. It's on a slightly different architecture. Blackwell, we can go into the specifics of why it's different, but all that you need to understand from a sort of markets perspective, and also like the political equation here, is that it doesn't do as much as the cutting edge accelerators that NVIDIA makes. But there's still anxiety from this administration that China could use it in the context of an AI supercomputer, and that they will try and argue presents a national security risk. And Kunjan's analysis is absolutely fundamental. You guys asked the right question. What's the distinction on a license and why a $5.5 billion write-down? A $5.5 billion write-down because NVIDIA probably knows it ain't going to get a license. Why else would you do the write-down and just clear that inventory off your desk? They kind of seem to have a sense of where this is headed.
So Kunjan, I mean, and I love what you said where this is headed, Ed, because I do feel like the devil's in the details, and we keep seeing different things in terms of, I feel like, the semiconductor world, but it does feel like this administration, bottom line, is going to continue to put some kind of restrictions in different ways. Is that a fair assumption? Is that a bad assumption?
Well, that is definitely a fair assumption. And look, the writing has been on the wall even before this administration steps in, right? That for the AI, the high-end AI semi-makers, the China market TAM is just continuing to shrink, and it will continue to shrink as we think even prior in this administration continue to sort of block or limit the amount of highest end performing chips that China can get access to.
Does it matter, Ed, in the long run? For China's AI ambitions, does this just slow China down, or does this actually hamper what they're trying to do? I mean, look what happened with DeepSeek.
Yeah, it's super interesting. I mean, even though the write-down on that inventory of H20s is indicative that NVIDIA knows the door's closing in that market, they could always come back with an even lower spec chip that is within the parameters of the restrictions as they understand them. One really interesting paradox here is the side effect of the White House's policy, which is that China does have some options, right? The context is that in the world of AI, 50% of the research is being done out of China. Literally 50% of all AI researchers are Chinese or Chinese citizens working somewhere around the world. But they have access to other technology. Huawei is increasingly becoming the national champion of China. It does not have a Blackwell, the highest performance chip that NVIDIA produces, but it does have something akin to the H20. And so now China has the ammunition, and poor word, the motivation to champion its own domestic player and say, you know what, have a leg up. Let's use your H20 equivalent instead. So
interesting. It was the exact conversation I was having with a colleague a little earlier, Ed. Kunjan, I want to bring you back in here because you're also watching AMD. Shares down 9.2%, 9.3% as we speak. The company said it expects to take a charge of as much as $800 million after the Trump administration put new restrictions on semiconductor exports to China. What is the AMD product that we're talking about here?
Well, AMD also has a similar watered-down version that it was going to ship to China. It's called the 308 versus the 300 series that it's shipping everywhere else. The impact on AMD, the number for AMD were surprising to us in terms of the exposure that we didn't think it had to China. I think when you look at apples to apples, the AMD will be impacted a lot more than NVIDIA here, because sort of when you think about the lower tier or the pre-Blackwell version of GPUs, this is where AMD competes with NVIDIA. And we thought, given the price competitiveness in China, this is where AMD could gain a little bit higher share than in the US. So blocking this off for AMD to China will impact it worse. Again, the scale is pretty different when you compare to NVIDIA and AMD.
So what I want to ask you guys, and let me go to you first, Ed. I mean, I just feel like the news out of the chip sector, I'm looking at the stocks, it's just getting hammered. All the names are down. I talked about NVIDIA, AMD, both down about 9% here in today's session. And we're looking at an index that is down about 6%. And we're down, 35% from peak to trough. I mean, is it just a normal semiconductor cycle that has, as you know, that Ian King talks about, its highs and lows? Or is it a really major rethink of AI? Or is it just overall kind of market malaise and uncertainty?
It's probably a rethink of supply chain, and it's really been good to learn about how the semiconductor industry works, right? This is where we tie in ASML. ASML was not under pressure because of technology export restrictions. That was a tariff story. But essentially, the thing that they have in common is that America wants the absolute cutting or leading edge innovation to be kept to America. It doesn't want China to have access. ASML does not make chips. It makes the equipment that makes the chips. But their specific equipment, extreme ultraviolet lithography machines, are $300 million a piece, and they are crucial to making those cutting edge chips. What the company told us this morning is we don't know what's going to happen. We cannot quantify it because it's more expensive doing business in America. ASML already does quite a lot here, but it assembles its final product in the Netherlands, and it has some Asia supply chain. So if you're a CEO, whether you're a chip maker, a chip equipment maker, or a designer, you now face a very simple calculus. It's going to be more expensive for you to do business in America, 25 to 35%. That's just the cost of doing things here. Or you face doing things in a jurisdiction in Asia, which we don't know the tariff on yet because of the temporary White House reprieve. That's different to market anxiety. Market fluctuations don't reflect the fluctuations that are happening within these companies right now as they try to assess how they're going to change their business models.
Kunjan, finally, final 30 seconds here in terms of your thoughts here as we look at what's going on in the overall semi space.
I mean, look, I've been in this space for 20 years, and at every beginning of every cycle, we say this is a different cycle, and at the exit of it, we say no, the outcome was still the same, no matter what the drivers. There is definitely something different here, where a lot of global geopolitics get involved. Put in context that last year we were sort of peak of valuations. The growth in AI was just increasing tremendously, which we know cannot be sustainable. So yes, the drivers this time look different for the cycle, but maybe the outcome might be still similar to what we have seen.
Okay, so not different this time around, right? Not yet.
Not yet.
Okay. Great stuff. Guys, thank you so much. Such an important story today, and certainly has one that's really got investors' attention. Bloomberg Intelligence Senior Semiconductor Analyst Kunjan Sobhani out there in San Francisco. Also in San Francisco at our bureau, Bloomberg Technology co-host Ed Ludlow.
This is the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Okay, Jay Powell covered, check, did that. We're going to do more a little later with Michael McKee. Semis, covered for now, did that. Now to the all-important, really read on the U.S. consumer. U.S. retail sales rose substantially in March on a jump in car purchases and other goods, such as electronics, suggesting consumers were scrambling to get ahead of tariffs. Maybe you buy a car, you buy a car, you buy a car before those prices go up.
You buy an iPhone, you buy an iPhone.
Maybe. Silvio Tavares is president and CEO at the credit data and credit risk analytics firm VantageScore. He's back with us here in the Bloomberg Businessweek studio. It's a joint venture of Experian, Equifax, and TransUnion. Good to see you this afternoon. Just an easy question for you. How is the consumer doing?
Consumer's healthy. We look at consumer health from a credit score perspective. A perfect Vantage score is 850. A really bad Vantage score is 300. Through the end of March, Vantage score average was 702. And
how does that relate to other times in the last 4 years, let's say?
Well, that is high. And in fact, it's 1 point higher than last month. So it actually increased, which was a big surprise. You would have expected, with all the headlines that you've been covering, that actually the consumer would not be credit healthy. We actually saw the opposite. Very positive.
Well, you know, it's interesting, too. And I guess what I want to ask you, I know you've been there for a couple of years, but I think Vantage Score goes all the way back to 2006. And there's just been a few things that have happened in that time. We've had the great financial crisis, we've had the COVID shutdown, and here we are today. So I am curious, when you throw these numbers out, how does it compare to other moments of crises?
Yes. So the real insight here is that the consumer does not feel crises. This is a Main Street versus Wall Street dynamic that we're seeing through the end of March. Main Street consumers feel credit healthy. They actually have a higher credit score. We saw actually consumer payments, so the late payments, credit delinquencies across every credit product, auto loans, credit cards, mortgages. All of those delinquency rates improved compared to February.
I got to push back on this Wall Street versus Main Street part of this, because we kind of saw proof with the UMich survey that we got, the results that we got on Friday, that this is bleeding into Main Street. Just to go over these numbers, year-ahead expected inflation at 6.7%. That's the highest going back to 1981. Preliminary April consumer sentiment falling to 50.8. The estimate was for 53.8. Our team called it ugly in terms of results. That seems to be hitting consumers.
This is where the difference in data makes a big difference. Consumers, what they say on a survey, like the one you just mentioned, and how they actually behave, which is the data we collect on their actual credit cards and other payments, there's a big difference. And what you see through the end of March, and this is the early view on the data that we're providing exclusively to Bloomberg, is that consumers feel confidently cautious, right? So they're paying down their credit balances. Credit utilization actually declined. They're actually working hard to keep up on payments. Credit delinquencies across all products actually declined on a month-over-month basis. So consumers are cautiously confident. What happens next, of course, is the big question. But what we can see is through the end of March, banks actually reduced their new lending. So banks are concerned, no question about it. Consumers are not as much.
So, Silvio, are consumers paying more on balances? Like, is the activity picking up? And I just wonder if it's anticipation of, like, things could get a little rough. Let's pare down let's cut down on our balances.
Yes, that's exactly what's happening. Consumers are actually paying more on balances, which
plays into what Tim was talking about, sentiment. If you're worried about the future, you might work on your balances, your credit balances.
Yes, and just to be clear, you'd have to be living under a rock not to perceive higher risk. But the reality is consumers do feel confident about where they are and they're credit healthy. Now, an alternative, Carol, you talked about what's happened in the past. If you look back at the 2008 crisis, what you saw there is a different behavior. Credit balances spiking significantly, and at the same time, delinquency spiking. We're not seeing that right now. In fact, it's the opposite. Balances are being managed well, and delinquencies are actually improving rather than getting worse.
How real time is your data? You're sharing data with us from March, but the so-called Liberation Day was April 2nd, and that was the day that caught everybody off guard. We can just look to the market reaction for proof of that. Do you have access to the April data yet?
We look at the data on a very regular basis, and the data, we have the most comprehensive and most frequent data. VantageScore credit gauge is published every single month. We're the most definitive source out there because we score all consumers.
All right, so cut to the chase. We have a minute left. What's the data showing you in real time?
Well, the data is showing us that this continued healthy credit behavior is continuing through the early part of April. But look, the reality is, as you heard in Chairman Powell's statements, there's more risk than there has been before, in part due to tariffs. Consumers see that as well, and they want to be well prepared for any new risks that can come.
So delinquencies aren't going up, or any of the activity that you saw in March, it's kind of the same thing you're seeing?
That's exactly right. And we're going to continue to monitor that, and I'm sure you'll have me back next month to talk more.
Silvio says everything's awesome.
Well, he said cautiously optimistic.
Exactly.
Cautiously awesome.
Exactly right.
Cautiously awesome.
Yes.
I like that.
Yeah.
Listen, thank you so much. Love looking at data and getting an idea of what the consumer is doing. So important to the economy. Silvio Tavares, he's president and CEO at Vantage Score, of course, the credit data and credit risk analytics firm, joining us right here in studio. Silvio, thank you.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I'm driving in my car.
Yeah, how about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. We've got just about 18 minutes to go until we wrap up the trade on this Wednesday, April 16th. Remember, it's today and tomorrow, and then we are closed Friday for the Good Friday holiday. So we're seeing, we did see some selling off of Jay Powell's comments on no Fed put and some other concerns, but we are kind of rounding off our worst levels of the session. So what does it mean?
We're only down 2.8% on the S&P 500.
But it was worse. And it's interesting with only about 18 minutes, 17 minutes to go that we aren't seeing maybe another leg down. So I don't know what that says. I don't know. But
I love the optimism that you have.
I know. But you know me. I always like to look and see what happens into the close.
Let's see what David Harden has to say about this. He's founder and CIO of Summit Global Investments. They've got about $2 billion in assets under management, usually based out in Utah. He's here in the Bloomberg Interactive Brokers studio. How are you watching this environment?
Well, both eyes, right? Like you can't take your eyes off the market. It's constantly keeping your attention.
It's like having a toddler running around the house.
I know.
You can't take your eyes off them.
It's Ricochet Rabbit.
They're
right?
going to fall down
exactly
the
what
stairs.
it is.
Yeah.
They're going to break something in your house.
Yeah.
So you have to pay attention. I almost was foreshadowed a little bit. We had this really good retail sales this morning. You're thinking, okay, we like that. Mark didn't move much, but okay. And I think that gave a little bit more freedom to Powell to say, okay, well, maybe I can be a little bit more lenient on being negative. And I don't mean negative like he's not a negative person. I'm not putting him down, but the news was received negatively. And people don't want to hear persistent inflation, right? They don't want to hear that. But the reality is we don't know. And that's what he said.
So what do you do in terms of investing right now? What have you been doing through the last couple of weeks here with all this volatility and people saying, okay, you don't sell at the bottom, got it. Tim and I were kind of joking off air. Yeah, okay, I get it. But if you've already lost potentially 10, 20%.
Yeah, we were 20% last week off the S&P 500 highs. We didn't close there, but we were 20% off.
Yeah. Right. But it could go down another 20%.
Well, it could.
That's what markets do.
You got to be real careful.
Or can do.
If you're going to
I'm not saying they are. I'm just saying that, does it make sense to be really cautious and say, all right, I don't want another 20% decline, potentially.
So that's the difficult thing. If you're going to, in the middle of a hurricane, try to put up plywood, not a good idea. Preparing for the hurricane, good idea. So one of the things that I hope this drives home
but if you're in the middle of a hurricane and you haven't put up the plywood, you go run. You go find some safe havens.
You get some protection for sure. And so there's two aspects here. One is that I hope that people take this away and say, hey, I need to have managed risk in my portfolio as a safe haven. I need to have some protection or downside protection all the time. It's not something that I go to when I need it. It's something that the plywood takes up space in your garage. It's just going to have to do that.
Were
right?
people not doing this?
No, I don't think so. I don't think people were managing risk. It was all about how much exposure at Mag 7 do I have? Right? That's not managing risk.
How much NVIDIA do I have?
How do you think people should manage risk? Obviously, it changes depending on the person, where they are in their life, and what their tolerance for risk is. But when you say downside protection, are you talking fixed income? Are you talking crypto? What are you talking about?
Well, like you said, it is client dependent, right? So for the large institutions that we manage money for, it can be like how you're actually buying the securities. When do you get in at different securities? What makes good? For example, right now, NVIDIA down so heavily today, right? Because of that China exposure and that big $5.5 billion, right? And AMD, $800 million. So if I was looking at tech and I was a big institution, maybe you look at something like, even though Google has ad revenue and people are going to pull it, right? They're going to slow down. It's going to have a hit. But $25 billion in cash flow in one quarter, 18%, year over year type of growth. It's a PE right now is around 16. This is getting attractive, and it's a different revenue source and non-tariff specific revenue source that if I was having to stay in tech, I'd move that. That's a transition that you could make right now in the storm.
What do you read when the United Airlines CEO comes out and gives you two different scenarios and says, okay, if it's a recession, here's what, our results are going to look like. And if not, okay, we're kind of going to be, business as usual. How do you read that?
Well, a couple things. Number one, leadership. You have to have leadership in a market like this. And here's a person that came prepared, right, with two different scenarios and showed a ton of leadership. This takes time to prepare. It takes a team to prepare. It tells you a lot about that team.
They had to go through the scenarios, right?
Yeah. It tells you a lot about his team. And not that there isn't good teams across the street, but he did a good job. And I think that's a pattern that other leadership teams in other, big companies need to follow. So one, very impressive from a leadership standpoint. Secondly, he called it. I don't know. I don't know what's going to happen.
Other companies say I don't know, and they pull their guidance.
Jay Powell
like Delta Airlines did last week.
Right.
Is this the same thing as pulling guidance? You're just providing best case scenario and worst case scenario?
In some respects you are, but I think that, hey, marketing is there for a reason.
Yeah.
And in some respects, I think that how you couch that message and how you share that message matters, right? Message really does matter.
And look, they still said that we're cutting capacity, United Airlines that is, cutting capacity in the third quarter of the year, and we're making changes to adjust for people not flying at the same rate that we thought they would.
I just got to mention, because
Yeah.
we're just seeing Hertz shares quickly jump up to session highs.
Sounds
this
like a good gainer for you.
Yes, and you actually pointed it out to me earlier in the day. So it is one of my gainers, but it's up about 28%. We've seen it up, I think, more than, let me just look, session highs here. We were up, I think, even closer to 30% here. We know that Pershing Square Capital Management has come out revealing a large stake in Hertz, specifically buying about 12.7 million shares. That was a filing that came out today. The stock's been up as much as 32%. So I just wanted to draw that to everybody's attention, since, I don't know, when you see a move like that, you kind of wonder if we might get some news here.
You made David pull out his phone. I wonder if he's buying something right now.
I had to check and make sure I didn't miss anything.
It's up 29% here, yeah.
But the market's still off. So
it's been higher all day, but it just took a big move to the upside.
And look, it's a company that's been beaten up, and it went
Totally.
through the bankruptcy process
Yeah.
and the Tesla issue, which is actually a perfect segue to talk to you a little bit about Tesla. Shares of Tesla off their worst levels of the day, down only about 7% right now, but it was down more than 7% earlier. So bouncing off the lows. You're steering clear of Tesla.
Well, I think you have to, right? I mean, number one, you talked about leadership earlier. There's a lot of volatility there, right? And we all love what Elon Musk has done. There's no doubt about it. But managing risk is somewhat about managing your volatility, right? It's not necessarily about our performance.
Yeah.
And so I think Elon Musk, from a personality standpoint, will let us know when it's time to buy Tesla. He hasn't done that.
What do you mean? Meaning he'll leave the government and go back to focusing just on his companies?
Yeah, I think he's an outspoken leader. I think he lets you know. I mean, he's not the now is a great time to buy stocks signal that we got on Wednesday of last week.
Yes.
Right in the morning.
You're referring to the president's post to social media.
Yeah, right. And it wasn't even a tweet, right, on his social
So
media.
you don't like the business, or you just don't like the stock right now?
No, I think the business is hurting. You see California registrations are down 15%. That was announced. It's negative earnings surprise. So I think it has had some negative business, but I think, and don't get me wrong, hey, I've driven a Tesla. You guys have all driven different cars. You love different cars. There's definitely a loyal following. I was driving behind a Tesla the other day, and a little bumper sticker said, I bought this pre-crazy.
Oh, we've talked about this on air.
Right? So,
I know.
Yeah, I think that's out there. But having said that, from a purchase perspective, I think there'll be better entry points in the future, and I think Elon Musk will let us know by announcements, he's a product guy. What's the next product? When he lets you know about that, that's probably your time.
I got to tell you, both Carol and I are obsessed with what's happening in China when it comes to vehicles.
Yep.
And just the more I learn about the EVs that they have in China from companies like Xiaomi, Huawei, BYD, the more I think we are so far behind here in the U.S.
Part of that's messaging, for sure. You're getting the good message, and that's how it should be. But part of it's reality. We are behind. I mean, take a look at some of our U.S.-based, if you want to say that, U.S.-based manufacturing and products. And our vehicles are not what they could be. And we need a swift kick in the pants and get better.
Just to remind everyone, and I bring this up all the time, in the fall, we talked about the Ford CEO, Jim Farley.
Mm-hmm.
He had been driving this Xiaomi SU7 EV. Do you remember this?
I do.
And he didn't want to give it up.
Which is pretty wild.
That's wild.
Right, exactly. If you think about it, the history of an automaker like Ford, right, and then thinking about that. So are there longer term implications from this political and economic environment, and potentially an environment that lands where we have a higher tariff? Maybe it's on China, maybe it's across the globe.
I think so. It's like you tell your kids, Carol, in the sense.
But can you bet on that there's already going to be longer term implications of this environment?
Listen, you can only make your choices. You can't choose your consequences, right? And so we can't do that. And the reality is there's going to be some consequences.
Actions have consequences. It's been like a thing throughout her. She's like, I know, Mom, I know. Actions have consequences, but go ahead.
But you can't choose them, and I think there will be some. Now, I hope some of these are the good things. I hope people realize, hey, I need managed risk in my portfolio all the time. I hope people realize, hey, I need diversification all the time. These are some really important things to kind of take home as principles to live by, not just need them when I need them. That's not the truth.
Well, how are your portfolios prepared for situations like this? Because when I asked you earlier, you talked about moving into Microsoft as basically a hedge, or Google rather, excuse me, a hedge for safety. Microsoft is another one of your picks. But geographically, are you overweight U.S.? Are you global when it comes to the equity side? There's been a big theme this year moving away from U.S. exceptionalism, and look no further than what's happening outside of the U.S. with the equity market returns beating the S&P 500.
For sure. And I think that's been, if you look at an asset allocation standpoint, this is something people have been saying for a long time, right? To diversify outside the U.S. Now, we still are more U.S. than outside as a whole, but our outside global holdings have been increasing. And we manage a global fund for clients, and that's a very attractive fund for them. So I think that you have to have some diversification outside the U.S. Absolutely. I think you also have to have some other exposure. Muni rates are doing really well right now. And quite frankly, our ETF that we manage, its ticker's USDX, it is more of a cash type product. And so can you get more on your cash if you have cash or need cash? These are some very important alternative income type products you can use.
I am curious about the global fund, because this is something that certainly we kicked off the year. Everybody was talking about Europe, although people were still talking about American exceptionalism as well. There was a point where the Euro Stoxx 50 was really showing some outperformance. We're now only up about 1.5% on the year, because it too has been beaten down. I mean, where globally have you placed money for investors? Where has money been flowing at this point? What are the international? What's the international portfolio?
Yeah,
I
think when you look at that, there has been money moving Europe ways. Definitely Germany.
I mean, I would take 1% right now, or 1.5% based on what we're seeing in the US.
As opposed to a decline of 10.4% this year.
Yeah, I'm in.
Yeah. Okay.
But go ahead.
Yeah, so I think Europe's a really good play right there. I think Germany's been a really good play, and there's still some stuff out in Southeast Asia and other areas. Most of that is just diversifying away from the uncertainty that we're feeling in the U.S.
But if there's uncertainty or recession in the U.S., then should we just assume that it's a global recession? Or is that how you would think of it from an investment perspective?
I would. I mean, think about it. S&P 500 companies to get over 50% or there close to of their revenues from overseas sales. We are a global society, right? By investing in the S&P, in some respects, you are investing in a global society. We're more connected today than ever. A tweet in somewhere in California lands in Dubai, and the whole market moves.
Speaking of the whole market moving, I bring this up all the time, so forgive me to our loyal viewers and listeners who just keep hearing me repeat the same thing over and over again. But the fact is, I have been speaking with friends who are not, people who follow this stuff each and every day, and this is getting on their radar. They're getting scared. They're pulling money. They're saying there's a structural shift happening. I have two friends who have done this. Their concern is that the U.S. is fundamentally weakening because of trade barriers that are coming up, and we're going to see a fundamental shift in the next few years. And they're no longer bullish on America. Are they making a mistake?
Well, I don't know about that, but I know that in every down market like this, same thing. We thought about it in 2008. I mean, big down. I don't mean like 2018, February 5th, one day. I mean, in these big down markets, 2000 and stuff, go out and Google Warren Buffett, 2000, doesn't know what he's doing. Go search for it. You're going to find article out article of very well respected, columnists, etc., talking about how Warren Buffett had lost his marbles and that the world changed. And yet, what was he in 2002? A genius again, right? And so
same with 08.
Yeah,
same with 09.
I think that it's warranted. I think you have to, check your ego at the door and be humble and think, is this a different market? Is this changed? And maybe making some changes there. But I think cashing out completely, I don't think that's the right way.
By the way, just a reminder, Berkshire Hathaway up for this year by 14%.
Yeah, again, I would take that as well. Hey, Hertz Global, by the way, is up about 52%. So the momentum to the upside, it is just off the charts. It's
what is going on here?
Well, it makes me wonder, are we going to get some kind of news or something?
Well, it doesn't hurt to have a pretty big private amount of the shares held. So it doesn't have a huge float as well on the Hertz. So that also can help with these short squeezes because there's not a lot of volume.
45% of the float was shorted. So, yeah, anybody who's seeing this move to the upside. But it does make me wonder on the news whether or not we could see something. We're going to leave it there. Thank you so much. And thanks for being with us and doing that deep dive into the markets. Dave Harden, founder and CIO of Summit Global Investments, joining us in studio. Folks, we've got about 3.5 minutes to go until we wrap up the trade.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.